Hello and welcome to Las Vegas to the 6th edition of the Infrastructure Summit by Structure Research. Joining me now is Mark McComiskey, CEO of AVAIO Digital Partners. Mark, it's a pleasure speaking to you.
Thanks for having me.
The theme for this year's conference is concurrence. So concurrence meaning a lot of things happening at the same time, and in this industry we are really now living the concurrency age. You've got AI demand, supply chain restrictions, you've got geopolitics, you've got regulations changing almost on a weekly basis, we've got energy constraints. There's an endless list of things happening at the same time. In your view, what do you think are going to be the trends that are going to really reshape or shape the growth of and development of data centers over the next year, 2 years?
Well, over the next year or 2 years, I think you put your finger on it. I mean, fundamentally what's happened is that the pace of technology change has bumped up against the ability of more traditional industries like power and land permitting to supply the needs of the industry. And so you've seen everything rammed together, and we now have shortages. And so the defining characteristic over the next couple of years will be the industry scrambling to find sites and power to be able to deliver the growth that they need to continue rolling out more generative AI, serving cloud services and the other needs of the customer base at a time when the electrical grid just can't respond to that. And so it'll be dealing with scarcity is going to be, I think, the big task to navigate over the next couple of years.
Okay, and then of course one of the big drivers for development, infrastructure development, is the hyperscaler demand. They come in, they consume a lot, and that drives a lot of the business and a lot of the investment that goes into data center facilities. From an investor perspective, and this can be either from an AVAIO perspective or just a general market perspective, how is risk and reward being calculated now when you look into investing into a data infrastructure project on the back of all this demand? And we'll talk about neoclouds after, but first let's talk about hyperscaler.
Well, look, I mean, we obviously invest in data centers, and we target customers that are hyperscalers, and we target customers that are neoclouds. When you think about risk versus reward and how that lines up against what's going on, the first thing to know is that the investment grade hyperscalers, the big 4 or 5 companies, they're considered to be very low risk businesses, and the financing markets have responded with a lot of product that allows very efficient financing of data centers for those entities. And that hasn't changed. If anything, it's gotten more efficient. And so as the industry has grown, as more and more financial players have come into it, it's expanded out from the traditional bank market into private placement, insurance companies and other things. And so the risk there is, it's well judged. They're priced like investment grade companies. The lease financings for the facilities are priced as a derivative of that. The neoclouds are obviously a very different thing, but the market is responding to that kind of in its own ways. And you're seeing hybrid deals where you get neoclouds that are backed by hyperscaler guarantees of one form or another, and then you've got unbacked neocloud deals where you're seeing capital that is willing to take a much higher risk but charge a much higher cost for it, supporting some of those deals.
Yeah, I was actually going to ask you neoclouds as a follow-up question because but it's a good thing because some banks are not really buying into neoclouds yet. They kind of want to see the use case done first.
I completely agree. I mean, we just did a round table with 6 of the biggest banks lending to data center construction, greenfield data center construction, and they all said they have no appetite for working with neoclouds, just none. That there's more than enough volume working with investment grade customers that they just don't need to work with the neocloud construction projects. And so the market that is responding to that at the moment, because it's much more nascent, eventually that will become more mainstream and the banks will start
usually scared off what's new as well.
Yeah, exactly.
It takes time to get comfortable.
So the market that is supplying that is kind of a slightly more specialized market, and there's less of it, to be fair. So that's not surprising. But the data center financing markets have been constructed on the basis of an investment grade form of customer and an investment grade financing, and the neoclouds aren't that. And so given how new they are, the market has yet to evolve a consistent response, but they're getting done.
Yeah, no, absolutely. And I learned yesterday there's almost 300 neoclouds now. I don't know how some people define neocloud at this stage because there seems to be way too many, but it is a growing side of the market. But the growing side of the market is also bringing some questions around maybe a bubble, because there's a lot of money coming in, and I mean, the question is very simple. Are we walking into a bubble or not? What's your take?
Well, so that's a really good question, and it requires a thoughtful answer. And so the traditional bubbles that we saw in things like the power build-out in the late 1990s or the fiber build-out in the early 2000s requires people to do an enormous amount of speculative building, right? You put billions and billions and billions of dollars into infrastructure without knowing that there's a customer. There isn't really very much of that going on in the industry. Even the Googles and the Metas and the Blackstone QTSs of the world, they're not building much without knowing that they have a customer. It's not a lot of speculative building going on. Having said that, and so in the actual supply of data centers into the market, I don't believe there's a bubble. Having said that, you are seeing around the edges, kind of in adjacencies, things where you look at it and you go, well, that doesn't seem right. You know, companies that are going public at $10 billion plus valuations that don't have a customer and don't own any land, don't have a data center, maybe that's a good idea, but you kind of look at that and you're like, that seems a little frothy. But those don't affect at the moment the supply of capacity in the market, and so even if they go away, you won't see a crash in terms of pricing or capacity.
Well, I mean, the vacancy rates are as low as they've ever been,
and falling.
Falling. We're really running into a place where there will be no supply at all.
Well, and you use the term concurrency. I think it's almost a collision, right? It's the demand is growing, and no matter what your projection, it's up, right? And all of the excess supply, which the United States has enjoyed for the last 20 years, because there's been no power demand growth for the last 20 years, has been used up. And utilities just don't know how to build power at the pace that's needed. And so, vacancy rates have plunged.
Well, there is actually I was going to say funny, of course it's not funny, but there's a bit of a tit for tat between energy operators with data center operators. So the energy guys are now blaming the operators for not having come to them a few years ago saying like, we're going to need all this, therefore we don't have energy for you, it's your fault. What's your take on this tit for tat?
You know, I think 4 years ago, ChatGPT hadn't been released, and so none of the customers knew they were going to need to be spending $2 trillion over a 7-year period to build out this compute. So that is a little bit unfair as an accusation, but it is completely understandable that the utility industry, which works on 10-year planning cycles essentially, is saying to the tech world, we don't know what you expect. It takes us 6 years to permit and get an investment case approved for a power plant and build it. And so it's just going to take time to do this. And I think that's, if the economic imperative is there to have the capacity earlier, you're going to see people step into the breach and explore things like behind the meter generation. Or you'll see the kind of democratization geographically of this capacity. If it's really, really, really needed, people will go to countries that have excess supply.
Picking up on your collision words, the market is also having to change the way it plans for these projects. So master planning has become really, really important. We are planning bigger campuses, faster campuses, new technologies, new materials, new architectures. But from an investment perspective, how does master planning benefit? What's the strategic value to an investor around master planning? How do you navigate master planning for a project?
Well, I mean, master planning is a phenomenon that's relevant to large campuses, right? If you're building a single building on a 30-acre plot, there's no concept of a master plan.
Straightforward.
Right, and so from the perspective of an investor investing in the creation of a master plan campus, the advantage of that is that it's really multiple. One, you get all of that approved through the local authorities before there's a chance for resistance to develop. So you know that you have that approved and you will be able to do it. You've kind of front-run that activities. Two, it makes it easier to explain to the customers how you're going to support a large build-out over time. And three, it allows you to be much more responsive. Instead of needing to go back every time the customer wants to talk about a new building on a site and work through the site planning process and the approvals, which can take from 6 months to 2 years, depending on where you are, you can immediately start construction. And so it accelerates time to market.
Let's talk about how you, or in this case AVAIO, looks into compelling opportunities for investment. How do you identify those? And again, everything is changing, so it's a concurrence, it's a collision. But you've got hyperscale solutions, you've got colocation solutions, you've got hybrid models, you've got new models coming up that we don't even understand yet. Then you have all the industry specializations within the client segment. How do you look into something, but like, this is good for us, we're going to go in with X amount of cash? What's the process? How do you identify those? And then we can talk about capital structures.
I mean, so when we started out, which is about 5 years ago, our view was that the rate of growth of demand in the data center industry was going to use up all the power available in the 5 or 6 cities where everybody went, in Loudoun County and in Santa Clara and Chicago. And so we decided to go outside of those areas and find locations where the power would be available and secure that power and get the locations permitted and zoned so that we would have a time to market solution for customers. And really, that kind of relies on an insight, which is fundamentally, no matter what the ultimate use case is, powered land in large quantities that is quickly developable is needed for all of those use cases. Then you get into, all right, do you have a latency sensitive use case? Do you need to be near a metropole? Or is power price more salient factor in kind of minimizing power price, in which case you could go somewhere else. So our approach has been to have a mix of sites, all of which have power and very quick time to market, but that speak to different use cases, so that as the market evolves, we can respond to wherever the fastest growth is.
Okay. And you mentioned you started 5 years ago. Again, a lot of things have changed in the last 5 years. So even ChatGPT didn't exist when you started. How have you had to recalibrate the business, and how fast did you have to move? So you wouldn't miss the boat on that one.
Well, and you know,
and that's not exclusive to AVAIO, by the way. Everyone has gone through this.
So when we started out, a 50 megawatt data center was a big data center. Now we're talking to customers who say, if you don't have at least 250 megawatts, you're meaningless to us. And so that has been probably the biggest evolution. It's gone from, hey, we need X amount, which is kind of reasonable in the grand scheme of things, to we need a big giant campus, needs to be lots of power, it needs to be available now. And so fortunately, we were already thinking along the lines of master campuses, and so we had several of those in process. But we've had several sites that were 25, 50 megawatts, which are just not interesting to people anymore, and so we've let those go by the wayside. But that's on the customer side. In terms of evolution, I think where a lot of people are now struggling is that the electrical industry, the electricity industry, the utilities are responding to this demand, and just in the past 12 months, they've changed the way they're approaching it. So you used to be able to just file for power. You could be, you know, a guy that had a field in the back of his house and say, I want 500 megawatts, you pay $10,000, and the utility would have to treat you the same way they would treat Google. And if you came before Google, you got the 500 megawatts first, you didn't have to pay anything, even though you could never do anything with it. Now the utilities are coming back and saying, listen, you have to pay $2 million for us to do this study up front. Then we'll tell you how much power you have and when you can get it and what it'll cost. And then you'll have 3 months to sign a power purchase agreement, or we'll take it away and give it to somebody else. And when you sign the power purchase agreement, you have to guarantee that you'll buy at least 80% of this power for the next 15 years, which is $1 billion commitment. And that is catching a lot of the people that are focused on developing new data centers by surprise. And it's really kind of going to wreak havoc, I think, in that business model, and only the better capitalized groups that have better ties into customers are going to be able to continue to do this approach of independent data center development.
That's very interesting. I hadn't heard that before. So the entry ticket has become a lot more expensive, time-consuming, and more pressurized.
Massively so. I mean, to the point of hundreds of millions of dollars of obligations.
Right? Wow. Which does not even guarantee you that you're going to get it.
Well, no, your application fee doesn't guarantee you anything, right? And so in Texas now, Encore is saying they want $15 million just to start a study. They won't tell you when they'll be done the study, and they won't tell you what the study will say. But then if you get the power, then you have to sign a contract to buy it. And they want letters of credit, and this is industry-wide, to secure that obligation. And those letters of credit can be $100, $200, $300 million. My
follow-up question is, how does that affect new market entrants? Because we were just talking about neoclouds, and there's a whole new segment for the market coming to the surface now appearing. But when we look into these specific situations, how does it affect newcomers, new players? Because you can no longer come here, just for exaggerating, but you can no longer come in with $10,000. You have to come in with millions of dollars just to get the studies done, try and secure something that's not guaranteed you're going to be able to do it, and then go and raise further capital for everything else that comes afterwards. How does that all affect new market entrants?
Well, as I said, I think that the evolution of that over the past 3 years is something that the market is just beginning to come to terms with. You will not find powered land speculators. I'll call them speculators. People that got a field, and I don't mean to denigrate that. They have some land, and they went and spoke to the utility and said, I can get some power. They will not be able to prosecute projects forward to the point where the hyperscalers or the neoclouds will be interested, because the cost is just too high. The technical requirements are now too high. And so if you're not within 24 months of being able to deliver a powered data center campus, people don't want to talk to you. And your land as powered land isn't worth very much unless you've actually signed an interconnect and secured that power. And small developers won't be able to do that anymore. And so what it will force is a reduction in the number of people pursuing that activity to those that are better capitalized, who are able to take on and manage those financial obligations, and you have the ability to ensure that as they complete those projects, there's a customer to pick them up. And that, I think, is going to reduce the supply of these sites and weed out a lot of things that weren't real to begin with over the next 18 months.
Okay, talking about geographies now. So AVAIO's geography, you're very much focused in the US.
US and Western Europe.
Yeah.
So we're in
Western
Spain
Europe,
and
okay.
Ireland and France.
Okay, well, I was going to ask you just to give us, like in this case, like a round the world quick trip of where you're focusing, the regions, the countries, where you might go next.
Well, let me give you some context. So we did a study recently because people are talking about data centers as kind of the infrastructure of the 21st century, the way railways might have been in the 19th century, right? And so we sat down and we divided the world up into regions: the United States, Western Europe, India, and China. And then we looked as a function of GDP at the number of highway miles, railroad miles, high voltage electrical wire miles by those countries, and then active data centers. And so the United States and Western Europe have about the right weight in terms of highway miles and electric miles, airports, for their population and their GDP. Very comparable now to China and India. The only area where the United States has a massive surplus of infrastructure versus any of those other countries is in data centers. The United States has a wildly disproportionately larger amount of data center capacity than the rest of the world as a function of the size of its economy. And so our focus is in the United States in terms of where most of our projects are. But we believe there's an opportunity because Europe, for example, is so underweighted vis-a-vis the size of its economy that there has to be, in our view, some degree of bounce back. And so we think Western Europe is an exciting opportunity, and the barriers there are higher, so you get less of this speculative kind of activity. So for people that know how to do it, then you have an easier path to commercialization. But the fastest growing region outside of the US is still the fastest growing region. The fastest growing region outside of the United States is APAC.
Well, I was going to ask if you're going to be looking into Asia as well, because Asia.
No, I'd love to, but we've got our hands full with US and Western Europe. We'll leave that to the experts.
You've got at least another 2-3 years until you maybe can consider something else. Look, I'm not going to keep you for much longer, but what's your top 2 priorities for 2026?
So we're laser focused on delivering the projects we have. We've broken ground on one of our projects, and we're hoping to break ground on 2 more in the next 5 months. And so it'll be commercializing and constructing the phase 1 of our sites here in the US. That is priorities 1, 2, and 3 for us.
Okay. And last question, from a capital perspective, what are you going to be really keeping an eye on in 2026? And this can be anything: finance, investment, debt, equity, valuations, multiples. What's the one thing that you, either as a business or personally, something that you're passionate about, are you going to be keeping an eye on?
You know, the kind of necessity for our business is to raise the capital that's needed to support the construction, which will be the better part of $6 billion. So on a day-to-day basis, that's what we're keeping an eye on. But from an intellectual interest and from ultimately an investment returns perspective, looking at the kind of valuations that are being attributed to the sector, the cap rates that are going up against them, and how those are evolving as more and more infrastructure comes into being. I mean, the Align transaction, obviously a very interesting transaction. The Fermi IPO, kind of everybody's looking at that and kind of wondering, wow, you know, what is happening there and how is that possible? And there will be, I think, more creative tapping of the capital markets in a way that will be very interesting to players such as ourselves that are building out.
You mentioned IPOs. I mean, last question I promise now. Do you think we're going to see a bit of an M&A of going public? Because outside of the data center space, some comes at delisting, so it's becoming a trend of delisting because it's expensive, there's a lot of regulations, it's just not as easy as it sounds. I mean, data center space, especially in Asia, they seem to be going towards the IPO route, which some might argue where we're going with the industry, the amount of capital that you need, is probably easy to stay in the private side of the coin as opposed to going public. But what's your take?
But then you saw Fermi go public and get a $15 billion valuation.
There's always a silver lining on it, wherever you look at it. But from your personal perspective?
I mean, honestly, I think that depends on the life cycle of the business that's involved, right? And so Aligned was taken private because it had reached a scale in the public markets that to achieve the growth that would really change its valuation, it was going to consume so much capital that you couldn't really finance that in the public markets. And there are private funds out there, as we saw with MGX and the others, that really have a mandate to deploy billions and billions of dollars of capital, and so that's a perfect match. But then there are mid-sized platforms, some of the ones in APAC and some that you're seeing here developed in the US, that are on the opposite end of that, right? They're kind of smaller, They have been at it for several years. Their private investors need an out, and the public markets are looking for opportunities to invest in something that could be a growth platform exposed to AI. And if you're going out at the $10 billion range, then you raise $2 or $3 billion. That can make a real difference in terms of your profile and give the kind of growth the public markets are looking for. So I think that's more driven by the idiosyncrasies of the life cycle of the business and where it sits than it is about kind of any macro theme that applies to all companies across all markets.
It's concurrence all around.
Yeah.
I'm giving you my promise. Mark McComiskey, CEO of AVAIO Digital Partners, thank you so much for talking to me.
It was a real pleasure. Thank you.
It was a pleasure myself as well. As for your home, thank you for watching, and do check our website and social media for the latest digital infrastructure news from across the globe. At the Tech Capital you lead, we report. Bye for now.